All right, ladies and gentlemen, welcome to Macro Ace. Okay, good morning, everyone. This is Macro Ace with your host, Tony. Hopefully you can hear me okay. We've got about a couple of minutes before we officially start. Just wanted to make sure, of course, everything is all fine at the moment for you guys, so you can all hear me and see the screen clearly. If you can, just give me a little heads up in the chat. Good morning, OS Futures Trader. How's your morning been so far? Hopefully it's been a good one. But yes, just whilst we have about a minute left, I just want to do a bit of the promoting or the promotion of products. Of course, we have the Macro Ace, which looks at the fundamentals of the news and combines that with to find what the sentiment is and to help traders prepare in the best way possible for the events that could come up and the events that come up ahead in the calendar, and also for other events outside of the calendar as well, or unexpected bits of news. So that's just again, we'll post a little link which you can use to sign up to our mailing list. If you do want to stay up to date, and if you do find this information useful, here is a link there. Also a reminder, I'll be starting shortly, but on YouTube there is a slight delay. Even though you can have it on the lowest latency, there is a slight delay in the video feed. So what we've done is we're also hosting a Zoom webinar at the same time too. Now Zoom is much faster than YouTube, so it's real time. There's no latency, so you're able to see the reactions as it happens in live real time, and you're able to jump onto that and of course be able to hear me in real time as well. So that's for our subscribers. If you want to subscribe, the mailing list is there, and you can join up and get the link for the mailing list. Excuse me, for the event. So Eia Inventories then, let's get through. We've got quite a bit to go through. Oh, E-mini OS feature trader said, awesome, caught the NQ. Nice, good. So what is it? It represents a weekly change in crude, gas, and distillate inventories. Transportation is affected the most. Of course, companies transporting goods across the country, that's going to have a heavy impact on those businesses. And of course, for consumers as well, you have the heating gas, and you also have crude oil or retail sell or retail pumps provide you with gasoline, or in the UK with petrol. So, and it also affects a number of other products too. With oil, you can create a lot of different things with plastic that is used, and petroleum jelly that is also created through crude oil as well. So there's a number of different areas that it can affect. Hence, it's a big release to be aware of, and it's a weekly release, which is even better. So why is it a release to watch? The main reason being it can be quite a volatile trade. Sometimes we can see what we've seen recently, at least a dollar move or about 100 ticks on WTI crude oil. So what we saw last week, we saw about $1.27 move, or about 127 ticks on WTI crude oil, off the back of a much better than expected or bigger draw in inventories than was expected. So it can be quite a volatile trade, and it can be quite nice when sentiment doesn't weigh too much on the oil market. So how does it affect the markets then, with what to expect? So when more oil is added, that is negative oil, i.e. if there's more oil added into the market and there's more supply, the demand starts to wither away, leading to lower oil prices. But if there is less oil in the market, or if there's a draw in inventories, okay, then that means that the price of the oil will go higher as there's more demand for it because there's less available to use. So hopefully that's quite clear for people just to understand the basic fundamentals of the release. Again, I'll go over it again. If there's a build in inventories, or if there's more oil added, then it's negative for oil. You'll see a depreciation in oil prices. And when there's less added, vice versa, you'll see an appreciation in oil prices when there's a draw or better than expected draw. So the triggers then for today, according to some economists as well, mixed in with their own. So crude looking for a high of 3 million with a low of minus 4.5 million. Gasoline with a high of 1.5 million with a low of minus 2 million. Distillate with a high of 1 million and a low of minus 3 million. And then API data. So API data is very useful to gauge what the official figure could be for the following day ahead. Now, usually with the API data, it was quite tradable itself as a release prior to the Russia-Ukraine invasion, where it would be used as a way to, as said, gauge what the official government report could be the following day. This is why traders have a focus on API, because there has been correlation where when API moves in a certain direction, whether it's in a build or if it's in a draw, then sometimes the EIA report can reflect that too, or move in the same direction. Hence, it's something to keep an eye on. So the API data, but saying that, there isn't always a complete correlation where if API is going to be built, then EIA is going to build. That doesn't always happen. So it's just something to be cautious of and be aware of, but something that traders do keep an eye on and just check just to see what the actual figure could be tomorrow, or gives them a better guess. So yesterday, crude oil stock change came in at a build as 4.78 million compared to the forecast of 2.167 million. Compared to the prior, that's a huge build there, as the prior was 4.496 million. MS says, good morning to you too. Distillate stock change actual was 0.431 million, prior was minus 1.652 million. So even though again, this is private data, so not all forecasts are given for these bits of data or is readily available. So we'd seen that again, there was a build there. Gasoline was in fact a draw. So compared to the prior of 2.933 million, it came out at minus 3.91 million. So that could we get similar data for today with the EIA? Again, there has been a correlation before in the past, but it's not been too strong or too overwhelming enough to say, yep, if API data is this is what EIA is going to be today or tomorrow. Okay, so market reactions then. So April 6th, we'd seen WTI crude oil weaken. April 13th, a couple of weeks ago, we'd seen it weaken by $1.30. And then last week, it was up $1.27. So if I bring up the deviation for you then of what we had seen. Okay, so again, so what we've seen on April 13th was about 132 ticks down towards the downside, and there was a bigger build overall compared to the other figures that were draws, but not as big enough to outweigh the headline figure itself. Then with last week, we'd seen, as said, after about 10 minutes of the release coming out, WTI crude oil was still up. WTI crude oil was up about 118 ticks from the release. Okay, and so it still held its move for quite a bit of time, where we had seen about 52 minutes later, only then did WTI crude oil actually erase its its gains that it made, or it erased that initial appreciation that it made after the release. So that's when the data was really good. But again, just a note of historically, that's what had happened. It doesn't mean that it's going to last for that long today. It could be quick snapshot, and that's it. But again, that was what we'd seen last week. Then it took about 52 minutes later, and then moved past the prior release level. Okay, so overall we had seen a much bigger build. There was a difference of 11 million compared to the forecast figure of the actual figure coming out. Again, there was an overall stronger draw in the figure, in the figures itself. So, which hence it led to a stronger or longer lasting reaction in the markets. So what could that mean today for us as what we're looking at ourselves? I think so. What we've seen in the past, if we get two bits of data that are showing, if we get the headline data that shows a really strong build or really strong draw, and the other two bits of data are more or less following in line with the headline data, then if it is an overall build, then we'll see a stronger move towards the downside. And then potentially, if we see a stronger draw overall for all three figures showing less inventories being added, we could see a stronger movement towards the upside, as we had done last week with the Eia Inventories report. But the big but is sometimes there can be, if you get two figures that are together that outweigh the headline figure, i.e. by the amount, then whether the headline figure is a build and the other two figures are a draw, it could mean that there's more of a choppy reaction, or there is a possibility that that WTI crude oil could move towards the downside instead, if let's say if the scenario is that there's a bigger build than expected overall, and vice versa, if there's a bigger draw than expected compared, and it outweighs or outnumbers the headline figure which we're trying to build, then there could be a more of a chopper reaction or movement towards the upside or some appreciation. So that's something to be aware of if there isn't an overall strong movement in one direction. If we do get data that's more or less in line with expectation, we might not get too much of a move happening. I remember economists and traders, they're looking for, generally with economic releases, if the data is as expected, it doesn't really create a lot of buzz. But when the economist or the government gets the data, or when economists get the data really wrong in either direction, then that causes a bit more havoc and a bit more volatility in the markets. So if the data is more or less in line with expectation, it depends. It could mean if the headline, we may see some movement, but that's not entirely, that might not happen at all if it's dead on, really. But again, that's the potential of what could happen for today. Right. So I've shown you the triggers, I've shown you the deviations and what to expect. What I wanted to go through is just show you the forecast figures then for today. So according to other economists, so they see a median estimate of 0 million compared to the prior of minus 8.020 million. Gasoline inventories, they see 1 million with a prior of minus 0.761 million, and then distillate with a forecast of minus 1 million with a prior of minus 2.664 million. So overall, the EIA is looking for a build in their inventories from today's data. Now, as said, we had the data yesterday, which had shown, the API had shown a build overall in the uh, or had shown a build overall in the inventories data that we had seen. So could there be could that correlation match up today? Well, we're yet to see. But if the EIA are looking for a build overall, then that might be the case. But you never know. Surprises always happen. Okay, so sentiment then. What is driving sentiment? So China, that's been fun. For a whole month, you had Shanghai that was locked down. But even then, you've had very strict lockdowns where people haven't been able to go out of houses or flats. And you've maybe seen videos on YouTube of people screaming from their windows of not being allowed to go outside. And there's a continuous mass testing that is happening. And that has affected sentiment in a negative way, where crude oil or oil futures extended their losses. Brent was down by $6 a barrel on April 25th due to of course, when the lockdown does happen, there's a loss of demand for crude oil. And because of that loss of demand for crude oil, that brings down the price of those inventories, of that asset or assets. So at the moment, if we're looking at Brent, it is down about 1.4% on the day. If we look at WTI, and WTI similarly down by 1.2% at $100. So just hovering above the $100 from what we'd seen. But overall, if we're going from the 25th, then we have seen a bring that up here. Yeah, so if we're going from the 25th, we have seen a significant move towards the downside. Well, we did see a significant move towards the downside, but a bit of a bounce back on WTI crude from the 25th of April. So still hovering at above $100 per barrel on WTI. But that was what was moving the markets then, and still has an effect as well. It still is having an effect overall. Now you've got to remember we're combining bits of sentiment together to get the overall picture. So what we had seen as well. So Europe, Russia oil ban, that there is no agreement. There was no agreement on banning Russian oil altogether. Borrell, the foreign minister, had mentioned that an important restriction on oil and gas or punitive tariff would put pressure on Putin and bring him to the bargaining table. At the moment, negotiations, there haven't been any negotiations between Russia or Ukraine for a very long time. So in the hope is that by causing a loss of oil revenue for Russia, in natural gas revenue, that could bring them back to the table. Schultz disagreed with it, saying that it could cause an economic crisis, similarly to what's been said today by the Germans. And that in turn, of course, we've got to remember about 37% of Europe's energy, or liquid natural gas, comes from Russia, and a similar amount of that in crude oil as well, or oil from Russia. So trying to remove that is going to be quite a difficult task. Now, you've also got Libya with the oil ministry saying protest-shattered fields might reopen within days, like OPEC members to resume full production. This is at the beginning of the week. So you've had Libyan oil disruptions earlier in the week that haven't outweighed the other bits of sentiment of China and Russia's oil ban and Ukraine's war, but it has added to seeing some strengthening in WTI crude oil or in crude oil prices. So they say that they could resume production could resume full production, but they had reduced daily output by around 500,000 barrels per day. And then on the 24th of April, they mentioned that armed clashes at the port of Zawiya damaged several storage tanks or 29 sites. So total open interest for WTI crude had fallen by 18% to 1.78 million contracts as of April 12th versus 2.17 million contracts on February 8th. So what that shows, or the reason why that I've included that there, is that there was, of course, for demand for oil, there was a loss in that demand from traders, and that was quite evident if we've seen how the market had reacted in the previous weeks or in the previous week or so. So that's what's made it a bit more. Again, if we go from Monday, that's why we had seen some of the earlier move towards the downside, and overall from April 12th, we'd seen that negative reaction from WTI, but there isn't any newer data to show an overall contract size, but that's the latest bit to show that there is a loss in demand. So that also has been weighing in on sentiment as well. So if we carry on, oil today though, if we see how it was so earlier on, of course it's still a negative. Oil did move higher as Russia stopped natural gas supplies to Poland and Bulgaria, escalating Europe's energy crisis. And NYMEX heating oil's quick spread surged to record on Tuesday. China's inventories are growing as a series of antivirus lockdowns reduced fuel usage. And only recently today did they say that they'll continue with their lockdowns during this COVID wave that they're seeing. Germany says that the country will continue to pay for Russian gas in euros or dollars, whereas the Russians wants everyone to pay in rubles. And German imports of Russian oil fell to 12% from 35%. So Schwedt is one of the sites that Germany uses to pump the oil into Germany. And that processes about 500,000, and most of it's from Russia. So what they're looking to do is actually amplify or remove the Russians from that, which could bring up oil prices in the future. But they're looking to replace that with more Western German oil where they can. So it'll be interesting to see how they perform that and how they do that. But as currently what's happening at the moment, that's what we see. So also, if we're looking at natural gas supply, we can see that you still see that Germany is about 25% of that, and as is Poland. And then you see the again, if for everyone else though, if we're in the 1 to 25% range in the UK, from what we can see here from Bloomberg piece, then we can still see that we're quite reliant on Russian energy. So trying to remove that is going to be a difficult task if most of Europe is reliant on Russian energy. So that could mean that with a withdrawal of Russian energy, that could lead to higher oil prices and natural gas prices, as we've already seen in the markets with natural gas particularly. And also, another one way that Europe is looking to replace Russian oil or Russian energy is to buy more North Sea crude to replace Russian oil. So European refiners switched to Forties and Johann Sverdrup crude. So before the war occurred, the majority of those grades moved to Asia. So now they're looking to gain more of the energy from if they're looking at another refiner in the North Sea instead, it could work. So of course, a reminder, if you're looking for energy from Norway, the main operators of that crude or of that refinery or of that field is Equinor. So you have Norway that when liquid natural gas consumption makes up about 20% of demand from Europe, and as said, Russia makes up of 31%. So there could be a way to look at Norway to provide more oil to Russia. Excuse me, more oil to Europe instead. Okay, so and then again here, Norway's about 16.5%. Excuse me, my apologies there. About 16.5% of natural gas comes from Norway, so it could be replaced with Norwegian natural gas. And the UK, we still pump a little bit of gas, or pumped a little bit of gas in 2020, and this is a BBC document or image, and about 3%. And then of course Russia with the majority of the power there. So they do have other ways. Europe does have other ways to look for alternatives, but for supply wise and supply disruptions, if you're thinking about how easy is it going to be to transport that more of that energy to your nation and ramp up that production, that is yet to be seen whether that's going to be how difficult of a task that's going to be. If you already have an easy way to rely on Russian gas, and you already have your supply chains all sorted out, there isn't a need to upend those, then it can be fine. But because they're going to get rid of the big 35, then that could mean there's more difficulties, and it could take longer for the transition between from Russia to other areas of natural gas and oil. But overall, I think for the markets, once that ban does happen altogether from Russian natural gas or Russian energy, then that could send energy prices further up if there's less available of it. We've got about 5 minutes. Just wanted to show. So yeah, again, just an image of crude oil prices tumbling from the 25th over the China lockdown issues, or continuation of those lockdown issues. So let's look at the prior release then of what we'd seen. So about for last week. So as I said, there was a overall draw in the inventories. We've put it to about 10 seconds before the release. And what you'll see is that $1.27 moved towards the upside. So yep, a draw there of 8.820 million compared to the forecast of a build of 3 million. So, and then overall, and the distiller was a draw as well, and gasoline was a slight build. So overall, there was a stronger report, or stronger figures in favor of one side for a draw in crude oil inventories and distillate. Hopefully you guys can see the video clearly. Let me know if you can't see it. But I guess as we've got about 3 minutes to go before the release, again, of course, the key place to look for that data as well is on the Financial Juice website with that real live data that we get out for you guys. Okay, so as you can see there, that was $1.27 move, or 127 ticks was the upside, and $1.27 move towards the upside there. So this reaction, as said, when we look at it historically, it took, let's go about 5 minutes ahead, it took about 52 minutes in its entirety after the release to see a movement, or see the release go back to its pre-release levels. But again, that was just one release that we recently seen of a really strong figure, so that there is the potential there for it to do that. So if I kind of skip ahead, let's kind of keep going. Okay, so that's about 10 minutes after the release, around about. And as said, deviation wise, crude oil or WTI crude, actually. Okay. So as said, at the moment, WTI is already down by about a percent and a half, 1.5% before the release. Again, there's a lot of mixed sentiment. About 4 seconds, 3. Okay, that's a build of 0.692 million, a build of 0.692 million, high, compared to the forecast of 0 million. Gasoline inventories showing a draw of minus 1.573 million, minus 1.573 million compared to 1 million for the forecast, compared to a build for the forecast. And distillate showing a draw of minus 1.449 million, much better, or a draw on the forecast of minus 1 million. Much better than expected figure. Slightly didn't meet our deviation of what we were looking for. There was a little pop beforehand. So I'm wondering if there's any bit of news, which, to be honest, I don't see anything else before the release came out itself. Okay, there's some choppiness. Okay, right, let's calculate these deviations then. So crude, 0 spot. Gasoline. And then distillate. All right. So if we're looking at the data overall, so overall there was a bigger draw on with the actual figures that we'd seen compared to the smaller build. Okay, it's still going up, so let's see how many ticks we'd seen. So originally, this is going to be a bit, a little bit, let's see, but what I did see was that initial move towards the upside. So it did finish flat on the candle, but as we can see, it's still going up. Okay, so it's about 50 ticks. We'll keep an eye on it, what it does about 10 minutes and see what the reaction is. But it doesn't seem to have, the initial move wasn't that strong. But seeing there, we'd seen about $1.06 move towards the upside. So that's a peak of it so far. So overall, there was, as I said, a bigger draw than expected overall in data. Hence, we'd seen this reaction here of a pop towards the upside. Now, whilst we're waiting for what's happened after about 10 minutes, and that'll give us a clear picture of indication or what the market is doing. If it still continues to see this slightly bigger draw, as worthy. Just a reminder, so financial juice. Now, if you trade economic releases, or if you're trading and you're unsure of what's happened in the markets, maybe there's been a big drop on the NQ or the S&P 500 or WTI crude oil, or the Dixie has gone up for some reason, you've got to remember that news always drives the markets. There is always something happening, and you can't deny that recently with the Ukraine Russia situation and the China COVID lockdown situation, those bits of news have moved the markets. So why not stay on top of it at a place where you can get all your bits of data together with your headlines, your voice, and your economic releases all in one place. So Financial Juice, the website here, you can actually subscribe. What you can do is you can sign up for a free trial of Financial Juice Pro to get that live, real-time voice news text service for you to be able to use. So what I'll do is I'll provide a link for you in the chat. I think there already is one in the description box, but I'm going to provide the direct link for you to be able to sign up to that here. So that's Financial Juice. Again, the more you know and understand what's going on news-wise and what's affecting the markets, the better you're able to position yourself, and the better you're able to protect your trades or adjust them. That's how I use Financial Juice, is a way to just protect trades that happen or that I have. Or that's what a lot of customers have said to us as well, that they use it to kind of protect and hedge themselves, or protect themselves from what's going on in the markets if there's extra volatility. And then also there is Tick Strike as well. So Tick Strike. So currently what we're seeing here, this Tick Strike, if we're seeing that there, that's showing us the pit noises, or the amount of amount of buying and selling that's going on. So imagine you're in the trading pit in, let's say, in Chicago, and you've got let's say the markets have opened, and then everyone decides to buy at the same time. Tick Strike, what it will do is it will light up. So currently, like this, it will show a plus sign showing that there is a lot of buying going on, and that can go all the way. If we can see about 15 is the maximum level. So I've got it on 1 at the moment to be ultra sensitive to the moves in the market, but Tick Strike, again, the reason why it's used is to help you listen to the order flow that is going on for a particular asset or assets altogether. So another 7-day free trial is in the link in the description, or in the link in the chat here. That is there for you guys to have a look at. But I think the final thing is, so actually, still seeing some move towards the upside on crude, and Tick Strike is showing that it's still seeing some life there. Okay, let's see. It's been nearly 10 minutes, so let's kind of capture. No, it's about 87 cents. 87 ticks. Okay, so getting close to a dollar move there. So okay, Tick Strike still showing that there's a lot of that there's still some more buy orders coming through. We are nearly comprende. But also remember, just as said as well. Now, if you're watching this on YouTube, as said, there is a slight delay. Nothing that I can control. It's just YouTube itself. There's always a little bit of a delay. So if you don't want that delay and you want to be able to watch the data live and listen to me speaking live, then what you can do is, you, as said, I've put it as the first link in the chat, is you can sign up to the mailing list for Macro Ace. And then what I'll do is every week or weekend, I'll put out the links, the webinar links for you to be able to join and listen in live. So as said, do click on that link, sign up to the mailing list if you'd like to. Also, don't forget to like and share this video. Subscribe to our channel on YouTube if you like the content. If you found it useful, then yeah, do please. That would appreciate that support a lot. Okay, 10 minutes is up. All right, 89 ticks. 89 cents. Meh. 89 ticks. Galaxy One, hey, hello. Where were you? Unless you were in the chat already. MS says thanks, good job. No worries. Thank you very much. Thank you for tuning in. Alrighty. So TickStrike is still doing his thing. I will leave that to run. I think if the okay, where are we now? So $1.15. Ladies and gentlemen, thank you for joining me, your host Tony, with Macro Ace in the Eia Inventories prep. A reminder for next week. Excuse me. For next week we have the FMC. This week we also have the US consumer spending, or the personal spending report. So we can do. So reminder for that. If I just bring it up here for you. If you do want to join us on YouTube, then you can use the link here that I've put in for the YouTube video. But what I'll also be doing is I'll be sending out a recording or replay of the Eia Inventories today, and I'll put in the link for the US Consumer Spending Report webinar for Friday in the email. Galaxy One says no trading today. Aussie Swiss franc closed. I'm waiting for the ECB at 6. Yep, that's going to be, yeah. I think the ECB is going to probably give a little bit more, well, forward, maybe some more forward guidance. But in regards to when maybe they might, hopefully they do give a bit more clarification as to when they would want to hike rates. You've had different members talking about maybe July or September or December, but July being the first one, being I think that was Villeroy, and who mentioned that he was looking for a rate hike. And yes, you're exactly right. You never know what Lagarde is going to say, or what's going to be released from that statement. Oh, of course, you're in a different time zone. Yes, of course. Yeah, Lagarde. I hope she does give some more clarification. In regards to some forward guidance of where the ECB is headed. All right, ladies and gentlemen, thank you very much. I will catch you Friday. Thank you very much for joining us. Goodbye.